Do you want to see how this couple is going to be able to retire at 62, but also save $600,000 in taxes along the way? Well, that's what we're going to be walking through in today's case study. And a couple came to me, Thomas and Kelly, and we're going to preserve their last name. We're going to call them Thomas and Kelly Sample. But they came to me and they said, hey, Jacob, here's our situation. Here's what we're trying to target in terms of our retirement date. We have three things that are really important to us. The first is we want to lower our tax bill throughout the rest of our life, if and where possible. And then also we want to enjoy life as much as possible through going to travel, visit our kids, and do the things that we really enjoy to do. And finally, they wanted to leave a legacy for their two kids. So those are their three primary objectives. So let's go ahead and jump into what their situation looks like, and then we're going to dive through some of the solutions that we came up with together to actually help them achieve all three of these items. So right here, we can see we've got Thomas and we've got Kelly. Currently, Thomas is age 59. Kelly is 55. Both of them intend to retire whenever Thomas turns 62. So we're looking at 3 years away, which means in 3 years, Kelly would be 58. So that's their target retirement date, and that's their current ages. So let's take a look at their overall assets and where things are currently. Right now, we can see that they've got a net worth of around $2.9 million. Now, that's comprised of a few different things. The first thing is if we look here at the left, we can see that Thomas has a 401k with his current employer. The value of that is $738,000. Thomas also has a Roth IRA worth $67,000. So not a huge Roth. Most of his retirement savings are in those tax-deferred accounts. To the right, we can see that Kelly has a 401k with her current employer. It's $943,000 is the current value of that. She also has a Roth IRA outside of her employer plan that's worth $112,000. Now, for their jointly held assets, we can see they have a bank account that's got around $150,000 split between checking and savings. They have a brokerage account with $372,000. They have an HSA with $34,000. Their house is not paid off, but the value of it is estimated around $650,000, and they have a mortgage where they owe $156,000 left on that house. So that's their current assets that make up that $2.9 million. Now let's take a look at some of their goals. So whenever they came to me, they said, hey, Jacob, our desired retirement age is 62 for Thomas and 58 for Kelly. And so that's where we're going to start. I think that they're probably able to do it at that age if they'd like to. So we're going to establish that as their retirement age. Now, how much money did they need in retirement? That's really one of the big questions I had for them is, hey, how much are you spending right now? And their current spending is around $10,000 per month. That's based on discretionary spending, how much they're spending on their mortgage and other items. So right now we're saying that they're going to need around $8,000 after tax in retirement to meet their normal living expense needs and be able to enjoy life the way that they currently are. So that's their goal, is they want to retire at 62 for Thomas's age, and then they also want to have around $8,000 a month for monthly expenses. That's after tax. Now, for their annual healthcare costs, now obviously if they retire before 65, they will have to make up that gap before they get to Medicare age. So Kelly has a lot longer time before she gets to 65 than Thomas does. But regardless, we want to make sure we factor in accordingly an accurate or close to accurate price on how much that might cost each year. So for both of them, I got the premiums and their deductibles around $12,000 a year in medical costs in terms of health insurance going private. And that does not include any sort of subsidies. So whenever we think about this, obviously they could reduce their income as far as possible and maybe get subsidies according to the Affordable Care Act. But in their situation, as you're going to see in a little bit, we're probably going to ignore those subsidies and do some other planning items that might benefit them more in the long term. So right now we're saying that $1,000 a month is their just healthcare costs. That's just for the insurance portion, assuming that they remain healthy and don't really have any major medical expenses. Now that's until they reach 65. Once they get to 65, they will go on Part A and Part B. And then also I'm going to have them in a Medigap plan, which will be around $3,500 per month, at least at today's rates. It will be obviously probably a little bit higher whenever they get to 65. So that's their healthcare costs. And they also mentioned that, hey, Jacob, we enjoy traveling. We've got two kids. They're both at the tail end of their college years, and we like to go visit them as well as just do vacations on our own. So they spend about $20,000 a year in travel, and so that's going to be continued into retirement. So what do I have there? I've got them spending around $20,000 a year. And the goal starts in 2026. That will be the retirement year for Thomas and Kelly. And then I've got them doing this every single year until Thomas reaches age 65. So a total of 13 years is how long they're going to be spending that $20,000 a year on travel. At that point, Perhaps health might become a concern at that point, but who knows? We'll just evaluate as we go. But for now, we're going to plan it out for at least that long. So that's their goals. Now let's take a look at their income really quickly and their Social Security. So right now, Thomas is making $135,000 per year. Kelly is making $200,000 per year. And Thomas's Social Security at full retirement age is estimated currently to be around $2,900 per month. Kelly's Social Security at full retirement age is going to be at $3,150. Now, right now, I've got them taking their benefits at each of their full retirement ages, which we will see in just a second. Now, since we're not 62 yet, we have 3 years until we get to that point. Here is kind of their savings until they get there. So Thomas is saving 15% of his income to his 401k, and Kelly is maxing out her 401k contributions at $30,000 per year using that catch-up contribution. So also they're saving about $1,000 a month to their joint brokerage account. Now, you're going to see here in a second, their cash flows look kind of out of whack because they have a bunch of leftover money. But remember, they've got 2 kids in college, and that's going to eat up most of their discretionary income that's left over. So that's where they stand currently. They're spending $8,000 a month or $10,000 or so. Right now, their goal is to spend $8,000 in retirement. So that's their situation. Now let's see, number one, can they retire? That's the first thing they wanted to know is, can we retire at 62 based on some of these assumptions? And right away, we can see that right here, we've got an 83% probability of success. So that's running a Monte Carlo simulation saying based on thousands of different potential outcomes, 83% of the time they will be successful. So I'm perfectly fine with that number. Now, obviously there's 17% that's left over, but in my experience, I find that 17% of the time, if things go that poorly, we'll make adjustments, we'll cut back on spending, we won't spend that $20,000 a year on travel and other things like that, that basically say we can readjust to get back on track. So that 83% is not saying you're going to fail 17% of the time. It's just saying that we're going to have to make adjustments at least a portion of that time if things don't go according to how we might expect them to. So that's where we stand currently. Now, here's their trajectory over time, assuming a baseline, giving historical averages in terms of returns. Now, let's see what happens whenever they get a 0% annualized investment return from this point forward. Well, we can see that they're going to increase their balances over time because they're still saving. But as soon as they stop saving at the end of 61 for Thomas's age and they begin accumulating and using their assets, they don't have very long until they run out. So they run out at age 78, assuming a 0% investment return. Now, how realistic is that? Well, I don't think it's very realistic, but we also want to make sure we plan for it. So that right there is going to fall into that 17% of the time. So we can see that a 0% rate of return is obviously not going to work out in their favor, yet they still are going to have money at age 77 and will basically run out at 78. So that's one thing. Now, what happens if they have a bad first 2 years in their investment portfolio? That sequence of return risk. We often talk about this and how important it is to plan for when it comes to retirement planning. But what happens? Well, the first 2 years of their retirement, well, we can see that it obviously goes down the first 2 years here. It goes down, and then it keeps going down until we get to age 92. So it lasts a lot longer because it's only 2 bad years as opposed to a 0% rate of return over the life of their plan. But we can see that they will run out of money at 92 rather than all the way to 95. Now, what happens if they have a strong growth scenario, meaning investment returns are awesome and things go really well? Well, obviously, they're not going to have any issues. So let's just reset this back to the baseline to just say we're going to expect average returns. Whenever we don't get those average returns on the low end, we'll make adjustments. If we get above average returns, perfect, we can go enjoy more of our money. So that's where we're at right now. We're looking at 83% probability of success. So here's just a quick look at their cash flows and what we're really looking at. So we can see that their income until they stop working for the next couple of years is $335,000, $342,000. Then obviously it goes to 0 because we're no longer working. That's whenever it goes down. And then these planned distributions here, these are actually going to be coming from the HSA. So what that's doing is that's paying for COBRA costs for their healthcare plans until they reach that 18-month mark. And then they'll have to go find private insurance. And then ultimately at 65, they can both go get Medicare. So this is going to dwindle their HSA. Now, I could change that and say, hey, let's pay that from somewhere else. But for now, we'll just use that as a planned distribution out of their HSAs to cover their COBRA health insurance premiums. So let's kind of dive into their expenses really quickly and see how this is broken down. So we see that their living expenses are around $120,000 per year. And obviously, it's going to be increasing over time due to inflation. Now, one thing I did want to point out is for now, we're not going to pay off their house until they actually are retired. And I'm going to explain why in just a second. But here are their housing costs for the next 3 years. And once they are fully retired, not earning any income, and also not taking Social Security, we're going to pay that house off. And the remaining balance is $103,000 at that point. Now, why would we wait until we're no longer earning an income? Well, the main reason is because we can do so in a more tax efficient manner. And here's what I'm talking about. They don't really want to pull money out of their cash account, which has around $150,000 in it. They obviously could use that money to do that, but they kind of think of that as their sleep at night number. They want to know that they've got cash available if things go really poorly. So they don't really want to touch the 150 because they want that always there in their bank accounts. Now, where else could we pull from? We could pull from their Roth IRAs to pay that off. We could pull from their taxable brokerage account, or we could pull from their IRAs. So whenever we think about this, whenever we actually pull from these different sources, they're going to be taxed differently. Any money we pull out of that IRA is going to be taxed like normal income. If we pull money from a Roth IRA, well, it's tax-free, but we're no longer letting that money accumulate and grow tax-free for their legacy that they want to leave for the kids one day. So that's an important factor to remember. So I said, what if we actually sell $103,000 in your joint brokerage account and we get to realize capital gains at a 0% long-term capital gain rate? Now, how is that possible? Well, whenever you have a certain amount of income or less, the capital gains rate is 0% on a long-term capital gain, or it could be 15% if you're above a certain income level, or it could be 20%. So with their income being $0, they're not working, and we're also not taking Social Security, and we're taking some assets out of their IRA to live on, a portion of that $103,000 is going to be at the 0% capital gain rate. The other portion would be at 15%. So that's a tax efficient way to think about how can I divest out of my brokerage account to also pay off my mortgage. So we're getting to do two things there at one time, which makes this a more tax efficient plan. So that's their situation. Their housing costs go away other than normal property taxes or general maintenance, which we can pull from their cash fund to pay that every year. So these are their living expenses over time. Right now, they are inflation adjusted, meaning they're just increasing at the general rate of inflation over time. So we can see that going up. Now, we're going to talk more about that in just a second and how that typically is not the way things go. So that's their expenses. Now, here's their tax payment the first couple of years. Obviously, we're going to be a lot lower immediately whenever we are no longer earning an income. So what does this do? It presents them an opportunity to do Roth conversions, perhaps. Maybe you've heard of those before, but we're going to walk through what that looks like in a second. But this is what I would call your gap years. This is the opportunity you can pay taxes at a low rate on a certain amount of money in your tax-deferred accounts, which lowers your overall taxes paid throughout the rest of your life. So we're going to dive into that in just a second. So they're also planning to save for the next 2 years $62,000 and $63,000. That's going to be going to their 401ks, like we mentioned, and their brokerage account. So that's their cash flows and kind of what we're looking at there. Now, whenever we start to do a couple of things in terms of what changes can we make to improve or increase their overall chance of success, but also their net worth over time. So right now they're spending around $8,000 a month. As soon as we pay off that house, that number can stay the same, or we have a little bit extra cash flow to work with. So that's one thing to think about. Now, right now they're not super aggressively invested. In fact, they're kind of like a 60-40 portfolio. So what if we increase that to a 70% stock portfolio? I'm curious how that improves things. So we see that it's a slight increase in the terms of the percentage, but we see a dollar amount increase that's very substantial. $600,000+ is going to be increasing there, which goes to their goal of leaving a legacy. Now, does it increase their overall chances of success? Not really, because what we're doing is we're increasing their risk profile, meaning the downturns in the market could impact them more negatively, but we want to make sure we have a plan for that. So also right now we're taking Social Security at their full retirement age, which is 67. I'm curious if we take that at age 70, max both of theirs out, does that help or hurt us at all? So now you can see that their chances of success have gone up by 2% from increasing it to 70% stocks. But what you can see is their dollar amounts here went down a little bit. And that means that they're going to have to pull on their portfolio for income each year for 3 more years, bringing down their total assets. And so by making just these few changes so far, we've increased their investment allocation a little bit. They mentioned, hey, we're not super conservative. We've understood and we kind of worked through how markets work. We know that if we invest, it will get the returns over time that we're looking for. It's just a matter of when that happens. So they're willing to take a little bit of risk. They're they're willing to accept, hey, we're going to take our full benefit at full retirement age, which is 67 for each of them. And we're going to keep our spending exactly how we think we need it. It's $8,000 a month. So not too big of a change. And so far, we've not had to push back their retirement dates at all. And just by doing those couple of things, we've increased their overall net worth at the end of life by almost $700,000. Now, whenever we do this, there's one thing that I wanted to pay attention to, which goes back to one of their primary goals was, hey, I want to save money on taxes if I can. So if we go back and look at their profile really quickly and see kind of where their assets are, we can see a big chunk for Thomas's retirement savings in his 401k, which is tax deferred. And also Kelly's 401k is also tax deferred. So Kelly's will be north of $1 million by the time she actually retires. Thomas's will be over 800,000. And that's simply based on their savings amount over the next 2 years alone. Obviously, if you get investment returns, it could be higher than that. So looking at close to $2 million of tax deferred assets, and they really want to solve for how can we lower that tax bill? So let's dive into what their tax situation looks like really quickly. So right here, we can see what I referred to earlier as the gap years. This is a period of time. We've got 4 years that they're paying a really low tax rate, if any taxes at all. So let's pay attention to that. And I wanted to mention one other thing here in terms of retirement distributions and kind of the order in which you can take from your retirement accounts. So right here, we can see that we do have some taxes in these first 4 years that we were just talking about, but that's only because right now the withdrawal sequence is set to pro rata, which is an equal percentage being distributed from a Roth IRA, the brokerage account or cash account, and then also their tax deferred account. So if we take an equal percentage, 33% of our living expenses from each one, or do it that way, that's what's called pro rata. Now, is that the best solution? Most of the time it's not. So instead, what if we took from our taxable account first, our tax deferred account second, and then our Roth account last, being that Roth account's primarily left for the kids as the legacy. What if we change it to that order? I'm curious if there's any improvement. So right away, by simply taking money throughout our retirement in a different order out of our accounts, we just increased our net worth by $440,000, meaning we're going to live and have that much more money throughout the rest of our life to go spend and enjoy or leave to our kids one day, and just by doing one small thing. So that brings back up the gap years, these 4 to 5 years that we have at a lower tax rate. So they wanted to do Roth conversions. Let's evaluate that for them really quickly. What if we filled up the 10% income bracket? Well, we can see that we went from $400,000 that alone was from changing the distribution withdrawal sequence to over $1 million by simply converting up to the 10% bracket every single year in these years. So you can see it's just for 4 or 5 years that we're doing that, but it makes a big impact on their taxes long term because we're cutting down on the taxes here in the later years of life. Now let's keep going. Let's see what the 12%, if we fill up that 12% bracket, so in 2023, it's over $80,000 that we can fill up in that 12% bracket, married, filing jointly. So it's actually $93,000 if we factor in a few different things like standard deductions. So right here, we can see that, again, we've increased their overall net worth by close to $2 million. I'm curious if we keep going, does it get better or worse? So if we fill up the 22% bracket instead of going only to the 12, it actually brings us back down just a little bit. So that might be a place that we want to stop. Or for them, it might say, hey, once we get to this point at age 82, we're not paying taxes ever again. To them, they really like that idea. So they said, yes, I get it. We're not going to have, quote, as much money based on these presentations and kind of projections looking forward. But for us, if we can stop paying taxes at any point in our life, we'd love that. So for them, for now, we're going to say we're going to continue paying Roth conversions above and beyond the RMDs that would kick in for them at 75. We're going to do that. Obviously, these are the primary years that the Roth conversions are going to be most impactful. But what does that look like on an annual amount? So if we look at the conversion amount each year, we can see at 62 in their first year of retirement, they're going to convert 185,000, 188, 183. And you can see here in year 4 of retirement, their conversion amount is going to drop off quite a bit because they're now having to live on those tax deferred assets in their 401ks and their IRAs. So that's something to factor in here. These are their gap years. These are whenever the most damage is going to be done in terms of lowering their taxes, but they're going to continue doing conversions to fill up that 22 or what would be the 25% bracket here moving forward. So we see that they're going to continue doing conversions until they reach 81. At that point, there's no taxes to be paid on their tax deferred accounts, which is what they want to do. So over here on the right, you can see that Their tax-deferred account balance is right here. Obviously, once they get to retirement age, it's going to be over $2 million or close to it. And so as we start doing these conversions, we can see the tax-deferred account balance going down, meaning their RMD amount will be a lot lower. Their tax-free account, being the Roth, is going to be increasing. So once that money is in that Roth account, they can pull from that account tax-free and penalty-free at any point. But also for them, what they really value about it is, yes, we're not going to pay any taxes anymore once it's in the account, but we're going to leave a tax-free legacy for our kids to help them jumpstart their careers, jumpstart their lives and their families, which is very important to them. So we're decreasing their tax liabilities and increasing their legacy to leave for their families. So that's really fun. They really enjoyed seeing that, and that's something we're going to implement for them. Now, whenever we go back to their overall plan and kind of looking at some things, let's take a look. They're obviously increasing and growing their assets over time. Right now, they're at around $2 million based on their spending, their investment allocations, and just average returns over time. They're looking at an increasing net worth for the rest of their lives. Now, let's take a look at their tax situation. How much should we help them and save for them by doing these conversions in the gap years? That way we can save taxes for them while they're living, but also taxes for them and their kids in the future. So right here is the baseline. This is without the Roth conversions factored in. So just by changing the few things we did down here, we're going to increase or save them taxes here by around $100,000. Now, what happens whenever we go ahead and turn on the distribution strategy to the distribution proposal? This is going to be the Roth conversion strategy that we just talked about and went through. How much does that help us? Over $600,000 of tax savings. So you can see right here that if we use these years, the first 3 to 4 years as their gap years, convert as much as we can up to that 22 or 25% bracket. Once you get to 2026, it becomes the 25% bracket. But even if we continue conversions through this point, we're going to see and help them save over $600,000 throughout the rest of their life, which means that once they reach age 83, they're not going to pay any taxes on their money, which is what they wanted. So through this, hopefully you can see and gain some ideas around what we're looking at, why we're doing certain things, because for them, we had 3 objectives. We had the opportunity to save taxes. They wanted to make sure they went and lived and enjoyed life. So we've got $8,000 a month going to them after tax spending. And then we've got $20,000 after tax going to them to go on vacations in addition to that $8,000 a month. And then also finally, they want to leave a legacy for their kids. So by saving on the taxes, they're going to have more tax-free assets to leave to their kids. And for them, their overall net worth is going to be increasing over time. So for me, this was a really fun plan to walk through. I got to encourage them and say, hey, look, here's how much money we're going to save on taxes. Here's how we can make a few different changes to your overall portfolio. Make sure we take Social Security at the right time and use your low income years effectively. And because of that, we're going to save them taxes. And then we're also going to be able to encourage them to say, hey, go enjoy your wealth. Go enjoy all the hard work that you've put in to build your assets to this level. And then finally, which they were really happy about, they're going to be able to leave a legacy for their kids one day. So what do you think about a case study like this? Was this helpful? I know this doesn't apply to everyone, but maybe the ideas or thoughts around this can help you kind of build a better plan so that you're more confident in your retirement. So leave a comment below. I'd love to hear feedback from you. And if you've enjoyed this case study, be sure to subscribe and like this video. That way you don't miss any future videos. Thanks so much, and we will see you next time.